Now, as we just mentioned, Berkshire Hathaway reporting earnings. Let's get some more details from a Buffett-style value investor. I want to introduce Paul Lountzis. He is the founder of Lountzis Asset Management. Paul, good to have you with us on Bloomberg.
Thank you,
results from Berkshire Hathaway, $1,800 a share roughly versus the Wall Street estimates of $1,400 for earnings per share. But the issue seems to be those derivative contracts. Are they a big issue for investors?
They are if you have a shorter-term time horizon. In 2008, they had a $6.8 billion derivative loss, and in 2009, it reversed to a $3.6 billion gain. In the short run, we don't really focus on that a great deal. We think in the long run, those derivatives are all going to work out for Berkshire. We focus on the individual business within each of the segments.
And you're a holder of Berkshire Hathaway stock.
It's 18% of our holding.
18% of
it's
the
our
assets.
largest holding.
Your largest holding, and so you're going to be very gratified by the increase in earnings per share.
We are. We were surprised. We thought it could be in the 1,600 range, but it seems like Geico in the insurance segment has done very, very well preliminarily. I haven't seen the release. And in their other sectors, manufacturing, services, and retailing, many of their businesses are continuing to improve.
All right. We're going to continue the conversation talking about value investing. More with Paul Lountzis of Lountzis Asset Management. A very busy Friday. Coming up, we're going to be talking about this morning's disappointing jobs numbers. That's next on Taking Stock. Now, Berkshire Hathaway's results, they were out just minutes ago. My guest is a Buffett-style value investor, Paul Lountzis, the founder of Lountzis Asset Management. Paul, if you take a look at Berkshire Hathaway's results, as we said, EPS for the second quarter, let's just say $1,800 a share. Everyone was looking for $1,400 a share. Factor in the jobs report and what's happening in the economy right now. Is this a market for value investing, or do value investors sit on their hands, wait with their cash, and see if the market moves either up or down?
No one really knows what the stock market's going to do. So what you should do is make sure you have plenty of cash reserves set aside to take care of your normal everyday things for 6 months, a year, or 2 years. And then beyond that, if you're going to invest in the stock market, make sure you have a 3, 4, preferably 5-year or longer time horizon so that you don't have to pull out at inopportune times. And ultimately, valuation is what drives everything. And even though the market has come back from the March 2009 lows, there are still many very reasonably valued stocks out there when you look at earnings, price earnings multiples, free cash flow yields, dividend yields. So I think the market is relatively attractive in certain names. But again, the compelling and outstanding values of March of 2009 are not around anymore.
All right, but you look at specific companies,
correct,
right? You're not looking at whether the stock market goes up one day or down the next day. What are some companies that you feel are good values right now?
Well, outside of Berkshire, which we think
13% of the portfolio.
18%.
18, I beg your pardon, 18% of the portfolio in Berkshire. So let's just call it almost 20%, a fifth of the money in Berkshire Hathaway
And we feel very comfortable with that. We also think that many of the businesses in the manufacturing, retailing, and services segment, Burlington Northern, we're sure probably had I haven't seen the earnings release, probably had a terrific quarter. It's the first full quarter that Burlington's going to be reflected in Berkshire's numbers. Many of the other businesses, Marmon, $5 billion in revenue last year, 130 businesses, Shaw Carpets, all those are improving. Mohawk's numbers were just out a couple days ago. So we think Berkshire's diversity and many of their businesses, Geico, we think probably had better numbers with what's going on in the auto insurance market. So the diversity and retailing as well, we think probably did better with the furniture, many of the furniture stores and jewelry stores as well.
But where's the money coming from if the consumers don't have jobs?
Part of it is they were down so low that even a small improvement. And they've also, like many other companies, they've cut costs. So even with a slight tick up, they're a lot more efficient now, and even without having the revenue growth that they may have had historically, there's still positive signs there.
Now, value investors, they're always looking to buy, what, like $1 worth of assets for 50 cents or even less. Have you found any other companies that qualify?
There are several companies that we own that we like, and there's a couple that we're looking at more closely. A couple that we like, that we own, Harsco, just had a second downward earnings revision. They have four real big businesses. The first is infrastructure, which is where all the problems are. And what's happened is
a lot of the scaffolding, for example. They make all this industrial scaffolding. If you see big construction projects or renovation projects, and you look, the scaffolding, it's Harsco.
Concrete forming, they also do that as well. And scaffolding all around the world, they can provide it. That business has really been hit globally. About 55% of the business was in Europe, and it's really slowed down, and they've underestimated the severity of the downturn. And I was just with some management members from Harsco yesterday going over the infrastructure business. But the other businesses, metals, Harsco Rail, and Harsco Minerals are doing very, very well. And we think if you look out 2 and 3 and 4 years, it's trading at a very, very low multiple of what we think it can earn over that time. And despite the challenges now in infrastructure, one of their large billion-dollar businesses, they're still going to generate this year $200 million in free cash flow, down from the $250 million estimate a few months ago. So it's still a solid. We think the management team's terrific, a good balance sheet, and it's the kind of stock we like to own.
All right, so Harsco, Berkshire Hathaway, value investors, they're always noted for reading up on the whole strategy of value investing. What's the one best book that you would recommend if someone wants to get involved in value investing? What should you read? What should you buy this weekend and actually pour over to learn about it?
That's a very tough question, but if you had to pick one book for the typical lay person, it would be The Intelligent Investor by Ben Graham, and I would focus on Chapters 8, The Investor and Market Fluctuations, and Chapter 20, The Margin of Safety.
All right, The Intelligent Investor. Always intelligent to have you on. I want to thank you very much, Paul Lountzis.
Thank you for having me.
Lountzis Asset Management. Now, investors got a clearer picture of the jobs market today, and they didn't like what they saw. What will it take to kickstart the jobs recovery? We're going to give you the details next on Taking Stock.